Namaste and welcome to the presentation on capital budgeting. Let's have an overview of what is capital budgeting. Capital budgeting is a process. It evaluates the feasibility, economic feasibility to be particular, in respect of projects or investments, basically long term. And how does it do it? It looks into inflows and outflows of cash and analyzes to find out, does the feasibility get facilitated by the cash flow. Here we have come across the word projects or investments. What does it include? It mainly pertains to fixed assets or additions to fixed assets, because they create the capacity to produce or generate saleable items. In addition to fixed assets, it also looks into any spending decisions of a company or firm which is likely to increase the capacity. You may add some machines to increase the capacity. It is a capital expenditure. You may add some automation into the manufacturing process which may affect the efficiency of it. You may convert a manual machine into a semi-automatic machine which may add to its lifespan and efficiency together. Or there may be some substitution or change in process which might lead to economy of operation. All these things will happen in respect of an existing assets. Therefore, capital budgeting looks into projects which cover fixed assets, additions to fixed assets, and also expenditure which is going to increase the lifespan of the assets, capacity of the assets, or their efficiency levels. And when we say projects, as we have seen in case of fixed assets, it might be increasing the scale of the operations by way of expansion, or replacing old machines by new machines, or adding a different line of activity but related to the existing activity as a part of diversification or integration backward or forward, or it may be a buy or lease decision, or it might have some relation with a project relating to research and development. All these qualify to be projects or investments to be covered under capital budgeting. And how do we do it? There are two sets of methods. First set talks of traditional method. Second one talks of discounted cash flow techniques. These are the two broad categories. Under traditional method, we have the well-known payback period, and accounting rate of return is another method, both coming under traditional method. Under discounted cash flow, though there are about 6 major which have got a specific identity in terms of utility, are net present value method, profitability index method, both are linked to each other, and third one is internal rate of return, which is largely used in respect of project funding. This is a overview of what capital budgeting is, what it covers, and does it cover replacement, expansion, diversification, etc., and what are the methods available. Now, this is the time to get into first set of methods, traditional methods, wherein we have got a payback period as the first method, accounting rate of return as the second method. And we will get their very nature by the terminology used in their nomenclature, payback period. What is payback period? For example, you invest rupees 2 lakhs and your annual cash flow is 1 lakh. Means with the annual cash flow, we can repay the entire investment within 2 years, which is nothing but 2 lakh divided by 1 lakh. Payback period simply looks into two aspects. What is your initial investment? How much cash flow you are generating every year? And how much period it will take to recover the entire investment. It determines how long it would take to recover original investment. That is what payback period talks of. And when you say cash flow is profit after tax plus non-cash expenses. Non-cash expenses are depreciation because profits are exactly in cash, but in addition to that, we would have charged depreciation while calculating the profits. But the depreciation are non-cash expenses, but they form a part of cash flow. Hence, we have to take a total of net returns before depreciation, but after taxes. Or to put it the other way, we have to take profit after tax and add back depreciation to it. Both put together is known as cash flow. This is a simple mention as regards payback period. Then we have got accounting rate of return. What does it states? It's a simple formula, accounting rate of return. Average net income. What is the annual income on an average basis? And what is our initial investment? As we saw, if annual income is 1 lakh and our initial investment is 2 lakh, our ARR is equal to 50%. As simple as that. It indicates total return on an investment. The project which gives the highest ARR. For example, if you have got project A, B and C and project A gives 50%, project B gives 40% and project C gives 10%, and if you can fund only one project, then you will choose out of A, B, C one which gives you the highest accounting rate of return. Project A gives 50%, therefore you will go for it. It is used for the sake of rationing the projects for allocation of financial support. And we can have an example to understand this fully. Illustration number 4, which says a limited company is considering investing a project requiring a capital of 2 lakh rupees as the investment. And its forecast says first year it will have income after depreciation but before tax, which is nothing but PBT, profit before tax, but after depreciation. First year 1 lakh, second year 1 lakh, third year 80, fourth year 80 and fifth year 40,000. This is so far as the profit is concerned, PBT is concerned. Then what it says? Depreciation may be taken as 20% of original cost. What is the cost? Cost is the capital outlay. 2 lakhs is the investment. 20% of it is nothing but 40,000 is the annual depreciation. And taxation of 50% of net income. Net income is nothing but profit before tax. Into 50% is going to be profit after you deduct 50% of tax, balance is equal to PAT. To PAT, you are going to add depreciation to derive the cash flow. Now, what the question asks? Evaluate the project according to payback method, rate of return of original investment method, and rate of return on average investment method. All the three are traditional methods. Let us get going. Now, as given, 5 years, PBT, 1 lakh, 1 lakh, 80,000, 80,000 and 40,000. And We are told 50% is tax. Let us apply 50%. 50% of 1,50,000, 50,000, 40, 40 and 20. Then PBT minus tax is equal to PAT, profit after tax. 100 minus 50, 100 minus 50, 80 minus 40, 80 minus 40 and 40 minus 20. Profit after tax is 2 lakhs and profit before tax was 4 lakhs. 50% of it was tax, therefore 2 lakhs is the profit after tax. We have understood one thing, profit after tax, and we have to add back non-cash expenses to find out how much cash was generated. Investment was 2 lakhs. We agreed with 20% depreciation on a straight line method. 20% of original cost of 2 lakhs is 40,000. All the 5 years it remains constant, and PAT plus depreciation is equal to the cash flow, which has to be considered for capital budgeting. 50 plus 40, 50 plus 40, 40 plus 40, and at the end of it 20 plus 40, 60. Total cash flow comes to 4 lakhs over 5 years. Now this is the basic working. Now we will answer questions of payback period. What payback period says? You are investing, you are earning a cash flow of 4 lakhs. Over how many years? Over 1, 2, 3, 4, 5 years. If you are earning 4 lakhs over 5 years, what is your annual average cash flow? 4 lakhs divided by 5 is 80,000 is the average. 90, 90, 80, 80, 60. 80,000 is the average. Then what is your capital outlay? Capital outlay is 2 lakhs. You are investing 2 lakhs and every year your cash flow towards recovery is 80,000, means how many years you need to recover? 80 per year, we have to recover 2 lakhs, means payback period is equal to capital outlay, which is 2 lakhs, divided by annual average cash flow. Annual average cash flow is 80,000. 2 lakhs divided by 80,000, 2.5. In the sense, the investment of 2 lakhs can be recovered within 2.5 years, although the plant is working for 5 years. If the plant is working for 5 years, if 2.5 your cost is recovered, balance 2.5 years is your straight profit. This is the payback period logic. First 2.5 years, you recover your money, and thereafterwards, whatever you earn is your profit on the investment. Then rate of return on original investment. We have two words here, rate of return and original investment. We know original investment is 2 lakhs. What is the rate of return? Average annual PAT, profit for 5 years is 2 lakh rupees. What is the average annual PAT? 2 lakh divided by 40,000. 5 is equal to 40,000. What is my original investment? Original investment is 2 lakh rupees. Then every year on my investment of 2 lakhs, I am making an average profit of 40,000. Means 40,000 over 2 lakhs is my return on original investment, which is nothing but 20%. Simple. Third, rate of return on average investment. Return remains the same, 40,000, average annual. This investment of 2 lakhs is the opening balance. Every year we will be receiving money and recovering our profits towards capital recovery. And opening balance is 2 lakhs. At the end of 5 years, what will be my capital? I will have recovered the entire 2 lakh rupees. It is 0. Then what do you mean by average? Average is nothing but opening plus closing balance divided by 2. Opening balance is 2 lakh rupees and closing I will have recovered by 2.5 years itself. My closing balance is 0 divided by 2. My average investment is 1 lakh rupees. Average annual profits is 40,000. Average investment is 1 lakh and my return is 40%. These are the three traditional methods of evaluating capital expenditure: payback period, rate of return on original investment, rate of return on average investment. We have seen under traditional method payback period, rate of return on investment, and rate of return on average investment. And all these figures are simple, straightforward from the books of accounts: profit before tax, profit after tax, depreciation, all from accounting books. And that talks of the strength of traditional method. They depend on the accounting information. There is no approximation, properly documented details. Fine. Number two, it talks of how much profit is made, how much cash flow is there, how much investment is made. Evaluates returns in terms of what is received, how much is received. These are the strengths of traditional method. There is no arbitrariness. But there is a weakness in this. It talks of what and how much. But you may receive profit of 50,000 in the 1 year, and in the 5th year you are receiving a profit of 20,000. Profit received today is not equal to profit received after 5 years. Because if you go to a bank and tell them, give me 10,000 rupees and I will repay you after 1 year, bank will say fine. If you tell them that give me 10,000, I will pay you after 5 years, he will say, wait a minute. We need to protect our interest in terms of income. We have got cost for time involved. For us, 1 year, year 2, year 3, year 4, they are different units of time. And your payment terms have to respect the time value of money. The traditional method has got a main weakness in terms of one thing: it ignores when it is paid. It just takes 5 years, divided by 5 and then says average. No, you can't cross a river by taking average depth at one point and the other bank, because you will be lost. Average doesn't work. For business finance, you have to ask questions. When was it received? Was it at the beginning or at the end? Then how are they valued? Profit 50,000 received during the 1st year is different regarding 40,000 earned in the 4th year. Or you may earn 40,000 each in 3rd year and 4th year. But they are not the same, because there is time gap involved from today. Now this is the weakness of traditional method. The traditional method ignores the time value of money. Any financial decision, you ask anybody, if you ask them to give money to you, they will say, when will you repay? And between today and repayment time, how are you going to compensate us? Because whatever time is lapsed between the two periods, there is value of money to be accounted. To overcome this weakness of traditional method, we have got the second method or second sets of methods pertaining to discounting. We have seen traditional method doesn't take care of time value of money. We need to understand what one of the greatest scientists talked about this particular weakness of financial evaluation. He said, there is a point to be noted here. He who understands it earns it. He was referring to time value of money. He who understands time value of money earns it. He who does not, he will pay it. Albert Einstein, and he was referring to time value of money, and his main reference was compound interest. Compound interest is the eighth wonder of the world. He who understands it earns it. He who does not pays it. One point I have to tell you as a financial professional, only one formula that will live with you for life as a finance professional and earn you dividends abundantly and give you an edge in every competitive field. That is the formula of compound interest, which is used in each and every decision of financial management. What is that formula? Future value equals present value into 1 plus rate of interest to the power of n, where n is the time. For example, if your rate of interest is per month, then n will be number of months. If rate of interest, say for example, it is 12% per annum and you are taking it for 5 years, then it will be 0.12 here and n will be 5. If you take it for months, it will be 12 divided by 12, 0.1, 0.01, 1%. Number of months will be 5 into 12, 60 months. He says, this formula is very important in every financial decision because we should look into the time value of money by applying the time, which is n, rate of interest, which is r, and apply it to the current value of investment. The same formula of compound interest, when you do it, if you keep PV here itself, then PV, it is getting multiplied by 1 plus r to the power of n. When you bring it to the other side, it will be FV into 1 divided by 1 plus r to the power of n. This is the derivative of the first formula. When PV is known, you can derive FV. When FV is known, you can derive PV, provided you know R as well as N. And this 1 by 1 plus R to the power of N is also called PV factor. Sometimes in your exams, you will be given PV factor. When it is PV factor, it is simply like this. You can just apply, replace this, and then PV becomes FV into PV factor. This formula we need to remember as a token of respect to Dr. Albert Einstein, the scientist behind E equals mc squared, and compound interest is what he highlighted, and that is taken care of by the discounted cash flow system of capital budgeting. Here we are trying to understand how a simple interest calculation works and how a compound interest calculation works as a preliminary basis for proceeding further. In case of simple interest, as we know, the principal will remain constant. The same amount is charged to interest from 1 to 10 years. Our example talks of principal of 1000, rate of interest 10%, and duration is 10 years. At the end of first year, or at the end of 7th year, or at the end of 10th year, interest charged is fixed, 10% of 1000. There is no change in the basis or the balance. And only the closing balance is just shown like that. Therefore, principal of 1000 and total interest charged for 10 years is 1000. Total is 2000 from the whole transaction. Interest remains constant. But if you go to compound interest, what happens? If it is 10% and 1000 principal, first year 1000 is charged to interest at 10%, 1100. Next year, the interest will be charged on principal plus interest. This is how the banks work. 10% of 1100, 1210, 1210 into 10%, and the process goes on till the 10th year. And when you see, if no interest is paid in cash, the accumulated amount under both systems will be 2000 for simple interest and 2594 for compound interest, suggesting interest under simple interest system is 1000 and interest under compound interest system is 1594. All calculations of finance is compound interest. For example, if you go to a bank and take a loan and they will charge interest on the various payment schedules, the charging basis will be compound interest. They will say, we will charge interest to your account and it will be compounded on a quarterly basis or a half yearly basis, on an annual basis. What do you mean by compounding? Compounding is added to the principal on a regular basis. 1000 becomes 1100, 1100 becomes 2010, 1210 becomes 1331. But there is a formula to derive these things. This is what we had seen. It is present value into 1 plus r to the power of n. What is 1 plus r to the power of n? 1 plus r is 0.10, 10%, 0.10 to the power of n is number of years. It is the first year. When it comes to second year, cumulative amount, it is 1 plus 0.10 to the power of 2. It goes on till the, and if you want to derive 2594, which is nothing but 1000 into 1 plus 10 to the power of 10, interest 10 times on the principal which keeps on changing, and that will give you the cumulative interest at the end of 10 years. And if you do this, 1.1 to the power of 1 means 1.1 into 1, 1.1. Second is 1.1 into 1.1, 1.21. 1.1 into 1.1 into 1.1, that is 3 times 1.331. Same logic it goes on, but there is a shortcut. Once you derive the first year, second year, simply multiply it by 1.1 into 1.1, it is 1.21. Third year, 1.21 into 1.1. This is what we have indicated here. And this proceeds. Where you are not given the factor, you can derive this if it is essential, but normally it will be given to you. And I'm just showing the process of deriving it. Therefore, when we say future value equals present value, that is 1000, into 1 plus r to the power of n. 1000 into 1.1, 1100, 1000 into 1.21, 1210, 1000 into 1.6105, 1611. This way we can derive the future value of 1000 every year under the compound interest, which presumes there is no repayment made here. And we have got one more factor which talks of, we said, if you take this formula and want to derive PV, then this will get shifted. It becomes FV multiplied by 1 plus r to the power of n. When you shift it, inverse of 1 plus r to the power of n, which is called PVF. If we take PVF and multiply to FV, you get PV. It is helpful sometimes. How does it work? 1 divided by same value, but in the inverse. It becomes numerator. 1 by 1 plus 0.10 to the power of 2. Similarly, it works out. You can also derive the same thing. This also will be given in exams. If it is not given, we can just derive the first one. It is easy. 1 divided by 1.1 is 0.9091. Next one, you derive by dividing it consecutively by 1.1. 8.264 divided by 1.1. It leads to 7.513. Next one, 7.513 divided by 1.1. This is easy to derive if you don't have a table with you, but it is not essential. But knowing the process is of use to the professional in you. PV means future value into PVF. What is future value? Future value in respect of second year is 1210. What is its current value? 1210 into 0.8264, it leads to 1000. Or after 10 years you are going to get 2594. If you want to derive present value, 2594 into 0.3855 is 1000. Now this is using the formula for generating either future value or from future value generating the present value, where you need 1 plus r to the power of n in its various combinations. This is just for the sake of knowledge. Having seen the traditional method, let us get into the second system of time adjusted discounted cash flow systems, or time adjusted cash flow techniques. There are three systems: net present value, profitability index method, and internal rate of return. These are the three methods under the discounted value system. What does the discounted value system do? It adjusts the cash flows for time value of money. Means the money in the first year is not the same as the money received in the 10th year. There is a discount for each delay of, say, 1 year. And under the discounted methods, we have three: net present value, profitability index, and internal rate of return. And there are a few more variants of it, which are just a rehash of these systems with minor cosmetic changes. And they are known as modified internal rate of returns, discounted payback, and terminal value. We will not be getting into the greater details of it, because what is more relevant is what is in practice. And out of these three systems, net present value system has got wider acceptance. Let us take net present value system. What does it do? It calculates the present value of cash flows. Simple. Whether it comes in the first year, second year, nth year, it takes how much is the outflow in 1 year, how much is the inflow in 1 year, takes the net amount and derives the present value. Present value is nothing but future value into the factor. And at the end of it, we have got a collection of net present values. A project with highest NPV is preferred. It is not that it is selected. It has to meet other criteria under other capital budgeting techniques. But once it is done, it is added into the list of priorities. But if the NPV is negative, the proposal can be rejected. It is just like you are depositing 10,000 rupees in a bank today, and they are giving you after 10 years a value of, say, 11,000. And if you apply this formula, the present value of 11,000 is come to 9,000. Effectively, what it means is you are giving the bank 10,000, and if you convert what the bank gives you, its present value is 9,000, means you are receiving less than what you deposited. Then the project cannot be accepted at all. It can be rejected. The rule is net present value has to be always positive. If it is not positive, we are not gaining anything. It's a waste of efforts. Profitability index is just a presentation of NPV. It talks of present value of inflows and present value of outflows. Supposing if I give 1 lakh rupees as outflows, I should receive, say, 1.2. What it says is present index, profitability index has to be always greater than 1. Means I should receive more than what I give. If I don't receive more than what I give, the conclusion is the same. The proposal can be rejected. There is a third one, internal rate of return. This is the one which is used normally with long-term projects, where you derive what is the effective rate. Here, in case of NPV and profitability index, you have a target rate of interest, say 10% or 12%. But in case of internal rate of return, we generate what is the actual return which the project is generating based on its cash flow, and that is compared with the target. Deriving the actual, the process is known as internal rate of return, and that the logic is similar to NPV. But and here one more principle that is applied in case of internal return is we take the inflows and we take the outflows and we derive the PV of both, PV of inflow and PV of outflow. And when we derive the IRR, we ensure that our present value of input or inflow is equal to present value of output. That is the rate of IRR. We will take examples and then look at. We are getting into the same problem with the question taking up calculate the discounted cash flow method taking cost of capital as 10%. What is cost of capital? Cost of capital is the rate which is used for discounting the future values. It is a rate of interest or rate of return. And it also asks about calculate the net present value index. We can attempt both in a single table. We have already worked up to this in our previous illustrations: PBT, tax, PAT, add depreciation, derive cash flow. Now what you need to do, cash flow is nothing but FV. We are supposed to derive the present value. What is present value? Future value into discount factor. Therefore, what we need to do is identify the discount factor against each inflow. How much it is? If it is 10% for the first year, it is discount factor is 1 divided by 1 plus 10 to the power of 1. Second year to the power of 2. Third, fourth, fifth, 1 divided by 1 plus 10 to the power of 5. What I have said is, if we derive the first one, even on a calculator, it is easy to do. 1 divided by 1.1, you get a value. Divide it consecutively for every year by 1.1. And that is what you will get. 9.01 divided by 1.1 divided by 1.1 divided by 1.1 divided by 1.1. Now simple, PV is nothing but FV into discount factor, multiply the two. Cash inflow, which is nothing but future value, into DF is equal to 81, 74, 60, 54, 37. Suggesting 90,000 received at the end of the year. If I receive it today, I should receive 81,000. If 90,000 received at the end of 2 years, if I receive it today, its value is 74,000. And 80,000 receivable after 3 years is received today, its value is 6,000 because I'm removing the interest or discount. 80,000 is worth so much today. 60,000 is worth so much today, meaning 4 lakhs which was going to be received at the end of different years over 5-year period. If I get it today, 3,08,200 is its value. Means it's just like by right hand you give 2 lakh rupees and based on discount you receive net amount 3,08,200 the same day. Will you accept the project? You will definitely accept the project because it is exceedingly profitable. Logic is whatever I give, I should receive something more than that. It may be even 1 rupee because it is already discounted. The logic is whatever I give should be more than, should be less than what I receive. Means I should receive more than what I give. 2 lakh is given, 3,08,200 is today's value of what I am going to receive in future. It is a fantastic project. Present value of cash. Discounted cash flow taking cost of capital. What is the discounted cash flow? This is the cash flow. It is discounted. And PV is nothing but discounted cash flow. Its value is 3,08,200. How much did you invest? You are investing 2 lakhs. On an investment of 2 lakhs, you are getting a net present value. This is present value. Deduct outflow, it becomes net present value. A minus B. 1,08,200 you receive as surplus over your investment of 2 lakhs. A project is accepted when NPV is positive. Whatever may be the value. Second is a derivative of this profitability index. It is nothing but output divided by input. Output is net present value, present value of the future stream of earnings 308,200, and outlay is 2 lakh. What we are saying is your seed of 2 lakhs is growing to be 308,200. Means how many times it is growing. It is ratio of future present value of future receipts divided by original investment. 3,08,200 divided by 2 lakhs, 1.54. The two questions are simply answered. This is the most popular method of doing the capital budgeting in respect of projects having longer duration of yield. Now, this is regarding the NPV system and net present value method. Simple, easy, but has to follow a standard template, understand the concepts. Now we are proceeding with the next system of capital budgeting, which is known as internal rate of return. Now, under internal rate of return, we are given a range, and within that range, we are trying to fit the project, how much it is really generating. In the sense, we know the project is giving one particular percentage of return, but we don't know exactly how much it is giving. This was a system of non-computer era where we started one trial and error basis. We take a discount rate, calculate the inflow. We take another discount rate, calculate the inflow, find out the difference between the two, and then derive what should be the midway of the two, where the logic in IRR is it is a rate where NPV equals investment. For example, I should generate or I should reiterate till if my investment is 2 million, NPV also should reach 2 million. When it is reached, I have received the exact internal rate of return. It is more manual, but when it is mechanical, it is at the stroke of a button. But the logic, let us just understand what it does. It basically does a simple thing. It equates NPV with the investment and gives us the exact rate. Using the same illustration, and our investment is 2 lakhs. Our future value is 4 lakhs. What we are looking for is what is the rate which values our cash flow equal to 2 lakhs. It should be coming to 2 lakhs. And let us, as an example, we will take it and we will start with 30%, 90,000 at the discount of 30%. When we find out the factor, discount factor, 1 divided by 1 plus 30 to the power of 1, 1.30, 1.30 to the power of 2, 1.30 to the power of 4. We put the discount factor. We calculate it. It is easy and simple. We get this. Normally, this is given in exams as a reference to the amount. You need not have to calculate, but if need be, we should be understanding the logic. Once we do this, we multiply. When I multiply 90,000 into 0.762, the present value comes to 2,03,000, whereas my target amount is 2 lakhs. How does the value come down? Your present value comes down as the rate of interest goes up. My target is I want to bring it down from 2,03,000 to 2 lakhs. I take one more rate which is higher than 30. In our example, we take it 32. 1 divided by 1.32 to the power of 1, 2, 3. We are taking 32%. The factor comes like this. And what is the value? Value is 0.7576 multiplied by 90,000. We get this amount. We continue like this. We derive an amount of 1,95,000. Now we have got two values. 30% we get 2,03,000 and 32% we get 1,95,000. But what we need a rate is between these two, because my 2 lakhs falls in between. For this we use a formula of interpolation, which is simple. At present value 30, 2,03,068. At present value 32, it is 1,95,000. Means you have exhausted 2% of interest for a reduction of 7,000. But what is the reduction I need? I need only 3,000. For 2%, you need 7,000. For 3,000, it may be around 1%. For that, you put a formula. Erosion required from 2,03,000 to 2 lakhs. I should bring it down. My requirement is 3,000, whereas here I am getting reduced of 7,000. Means roughly about 45% is what I need to do it. We have a formula. For 3,006, we have got 2% lost. For 7,128, how much for 3,068? We just put the simple mathematical formula of my target is 3,068. What the working is giving is for 7,028. How much I should lose within this 2%? It is 0.86. Means this is 30. In between 0.86, if I add, that will bring my present value to capital outlay. How do you prove? You can just go for a verification. This is the thing, and my discount factor now is 30.86. Put this formula, derive the value. Now you know when you do it, CI into DF, you are getting almost closer to, because we have a decimal closure at 2, 199,946. This is the verification. You might not be required to do it in exams. Why I am saying, just to understand, for a conceptual clarity. IRR means where the investment is equal to the amount of money received. That way this project gives a return of 30%, 30.86%, and which is fantastic. Now this is the third system of generating. We have seen in the process traditional method, payback, accounting rate of return, and time adjusted discounted cash flow techniques. We have seen net present value, profitability index, and internal rate of return. Of all the systems, what is largely used and more scientific is the net present value, and it gives more details, and profitability index is only a variant of it. Hope you enjoyed the presentation. Thank you so much. Thanks a lot. We will meet once again with problems on net present value system. Thank you.